Well, hi everyone, Shaun Humphries here. Welcome to All Things Retirement. In today's video, we're going to talk about one of the three risks that retirees really need to be focused in on, not just in the planning phase of retirement, but it's something you need to be looking at every year that you're retired. And that's the whole issue of inflation risk. Now, inflation risk is one of those risks that's kind of insidious. It's not a dramatic kind of thing. It sneaks up on us. But as we see an erosion of purchasing power, it can have a huge impact on our retirement plans over a long period of time. So it's not like, what's the impact on NAFTA negotiations or economic declines or market risks where the markets go down. And there are strategies in each of the areas that I just talked about where we can mitigate the risks attached to those things. And the same thing applies with inflation risk. It's not like we don't have tools in our kit bag to deal with the risk, but it's very important we begin to model the impact and then put in strategies that will help us cope with inflation. So to get the conversation started, let me just look at a very simple example. So this chart basically goes over the impact of inflation on $1,000 of income. And going left to right in the chart, you can see the different inflation rates going from 0 to 4%. I'm going to focus in on the 2%, 3% numbers. They seem to be more relevant for our current environment. So if you go to number of years, 10 years, you go across the chart, you can see in 10 years at 2% inflation, the purchasing power of $1,000 is $820. And if we go on to 3% inflation, it's now $739 of purchasing power. Not an insignificant loss of purchasing power over that decade. Over 20 years, the purchasing power at 2% inflation is $673 from $1,000 initially, and it's $545 at 3%. It's almost a cutting in half of the buying power of that $1,000 of income. Now, this is why it's really important. You often see people planning for retirement look at their government pensions, maybe their employer-sponsored pensions and their financial assets, and they'll do some rough calculations, and it really looks like they've got sufficient money to sort of meet their after-tax incomes. And that may very well be the case, but what they often don't do is look at the next 5 years to 10 years to 15 years and forecast out how inflation will impact the income that they're receiving and whether they can maintain that level of spending. That's a really important kind of forecast to do, because how that forecast looks will have a profound impact on how you handle how much you spend, what kind of strategy that you'll use for your portfolio as an example. There's a whole bunch of ripple effects around the forecasting of the impact of inflation on your cash flow over time. So I'm going to give you an example of one of the things we do for clients all the time. This chart comes from a financial planning, financial retirement income modeling software that we use. And there's a whole bunch of spreadsheets behind this chart, but this chart summarizes a few things. If you look at the chart from left to right, there's a line that cuts across to the top, and that's the client's goal from an after-tax income standpoint. They wanted roughly $60,000 a year of after-tax income. That was adjusted for inflation every year, and you can see that just around 2% inflation, that income need through their life expectancy goes from around that $60,000 to roughly almost $100,000 of after-tax income need. Now, when we first did this analysis and we looked at the impact of inflation, the client didn't like the results of the analysis, because what happened is the green, which represents what they're drawing from their financial assets to bring their cash flow to the required level, was fully, at least theoretically, was fully used up by their mid-70s. And that was clearly not a great result, and they wanted to look at strategies for overcoming that. So we introduced a couple of strategies in their financial planning to help them cope with that inflationary impact. This was one of the charts that we ran after introducing one of the strategies, and that took out the portfolio life expectancy out to almost their life expectancy. You can see it's the late 80s, almost 90 years of age. They still wanted to have some legacy value in their portfolio. There's some other strategy we then introduced, but it allowed them to begin looking at the ripple effect of various strategies that we could introduce to help them cope with inflation. So when you are doing your own retirement income planning, make sure that you begin to factor in the long-term effects of inflation. If you're working with an advisor, they will have the ability to run these forecasts, at least I hope they do, and they can begin modeling the impact for you. If this is something you'd like to do for your own situation, you'd like to look at the impact of inflation on your planning, don't hesitate to reach out to us. We do this kind of modeling all the time, and we have a complimentary service that we offer that begins to look at the modeling for individuals so they have clarity on their retirement income planning. And if you look at the chart or the video, we've got our contact information in front of you, so feel free to reach out to us.